What if I told you that you could master your finances, invest like the world's wealthiest individuals, and stay calm during market crashes, all without needing a finance degree or decades of experience? Today, we are diving into Unshakeable, your financial freedom playbook, a game-changing collaboration between two financial powerhouses. First, there's Tony Robbins, the legendary peak performance coach, best-selling author, and entrepreneur who's helped millions transform their lives. Then there's Peter Mallouk, a certified financial planner and CEO of Creative Planning, one of America's top independent investment advisory firms, managing over $200 billion in assets. Together, they have created what they call an Unshakeable playbook, a practical guide that cuts through Wall Street's noise and gives you the tools to build lasting wealth, regardless of market conditions. Here's their central promise: you don't need to be a financial genius to achieve financial freedom. You just need to understand how the system really works and, most importantly, master your emotions around money. Think about it. How many people do you know who have made money in a bull market, only to lose it all when things got scary? How many have been paralyzed by analysis paralysis, afraid to invest, because they don't know where to start? This book is not about getting rich quick. It's about getting rich for sure. It's about becoming the kind of investor who sleeps soundly at night, knowing their financial future is secure, regardless of what tomorrow's headlines might bring. Over the next half hour, we will explore the mindset shifts, practical strategies, and insider knowledge that separate successful long-term investors from everyone else. We will discover why most people fail with money, and how you can avoid their mistakes. Ready to become unshakable? Let's dive in. Part 1. Becoming Unshakable, a mindset first. Before we talk about specific investment strategies or financial techniques, we need to address the elephant in the room: your emotions. Here's an uncomfortable truth that Robbins and Mallouk hammer home throughout the book: financial success is not primarily about money. It's about emotional resilience. It's about developing what they call an unshakable mindset. Picture this scenario: you have been diligently investing for several years. Your portfolio has grown nicely. Then, suddenly, the market crashes. In a matter of weeks, you watch 30% of your hard-earned money disappear. Your stomach churns every time you check your account balance. Your friends are panicking, selling everything. The financial news is predicting doom and gloom. What do? This is where most people fail. They panic. They sell at the worst possible time, locking in their losses permanently. They let fear override logic, emotion override strategy. But here's what Robbins learned from studying the world's most successful investors: they think differently. They understand that markets go up and down, that's what markets do. They know that corrections, crashes, and volatility are not bugs in the system, they are features. As Robbins puts it, winter is not forever. And neither are market crashes. Think of market volatility like weather. You don't sell your house because it's raining today, knowing that sunny days will return. You don't panic because it's winter, knowing that spring always follows. The same principle applies to investing. The wealthy understand something that most people don't. It's not about timing the market, it's about time in the market. Every day you delay investing, because you are waiting for the perfect moment, is a day you are missing out on potential compound growth. Consider this historical fact that Robbins shares: if you had invested $1,000 in the S&P 500 in 1942, and just left it alone, despite living through 13 bear markets, your investment would be worth over $5 million today. That's the power of staying invested and staying calm. But here's the catch: to achieve this kind of result, you would have had to resist the urge to panic and sell during every single market downturn. You would have had to remain unshakable when everyone around you was losing their minds. The book teaches us that becoming unshakable is not about suppressing emotions, it's about understanding them. It's about recognizing that fear and greed are natural human responses, but they are terrible investment advisors. Robbins introduces what he calls the unshakable mindset, a way of thinking that allows you to stay calm, informed, and committed during market volatility. This mindset is built on three foundational beliefs. First, volatility is normal and expected. Markets have always been volatile, and they always will be. Expecting smooth, steady growth is like expecting to drive cross-country without hitting any traffic lights. Second, time is your greatest ally. The longer you stay invested, the more likely you are to achieve positive returns. Short-term thinking leads to long-term poverty. Third, your behavior matters more than market performance. The investor, who stays disciplined during market downturns, will always outperform the one who panics and makes emotional decisions. Remember this, the market doesn't care about your feelings. But your feelings can destroy your financial future if you let them drive your decisions. Becoming unshakable means developing the emotional discipline to stick to your plan, even when, especially when, it feels uncomfortable to do so. Part 2, the truth about market corrections and crashes. Let's talk about something that terrifies most investors, but should not: market corrections and crashes. Robbins and Mallouk spend considerable time in the book demystifying these events, because understanding them is crucial to becoming an unshakable investor. First, let's define our terms. A market correction is typically defined as a decline of 10% or more from recent highs. A crash or bear market is usually a decline of 20% or more. These sound scary, right? But here's what most people don't realize: they are completely normal. Since 1900s, the US stock market has experienced a correction of 10% or more about once every year. Read that again, every single year. Yet, despite these regular setbacks, the market has trended upward over time, delivering average annual returns of around 10% over the long term. Think of it this way: if you knew that every year, your favorite store would have a massive sale, where everything was marked down 10 to 20%, would you be terrified? Of course not. You would probably get excited about the buying opportunity. Yet, when the stock market goes on sale, most people run away screaming. Robbins shares a powerful insight from his research: the biggest mistake investors make is not buying the wrong stocks or choosing the wrong funds. It's selling when they are afraid. They buy high when everything feels good, and sell low when everything feels terrible. It's the exact opposite of what successful investors do. Here's a sobering statistic from the book: the average investor earned just 2.5% annually over a 20-year period, while the S&P 500 returned 9.85% annually during the same time. Why the massive difference? Emotional decision-making. People bought and sold at exactly the wrong times. Let me give you a real-world example that Robbins uses. During the 2008 financial crisis, many investors panicked and sold their investments at the bottom. They watched their portfolios drop 50% or more and could not take the pain anymore. But those who stayed invested, or better yet, those who had the courage to buy more, saw incredible recoveries. The S&P 500 not only recovered all its losses but went on to new highs. The book emphasizes a crucial mindset shift: market dips are not disasters, they are discounts. When your favorite stocks go on sale, that's not a time to panic, it's a time to potentially add to your positions, if you have the financial capacity to do so. Robbins and Mallouk teach us to reframe our relationship with volatility. Instead of seeing market downturns as threats, we should see them as opportunities. Instead of fearing corrections, we should expect them and prepare for them mentally. This doesn't mean we should welcome financial crises or hope for market crashes. But it does mean we should understand that they are part of the investing landscape, just like storms are part of the weather. You don't stop leaving your house because it might rain, and you should not stop investing because the market might go down. The authors also point out something fascinating: some of the best investment opportunities in history have come during the darkest financial times. Those who had the courage and liquidity to invest during the depths of the Great Depression, the 1970s stagflation, the 1987 Black Monday crash, the dot-com bubble burst, or the 2008 financial crisis were handsomely rewarded. Here's the key lesson: your ability to stay calm and rational during market turmoil is not just a nice-to-have skill. It's the difference between building wealth and losing it. The investors who panic during downturns are essentially transferring their wealth to the investors who remain calm and disciplined. Remember, every market correction in history has been followed by a recovery. Every bear market has been followed by a bull market. This doesn't mean the next correction will be short or shallow, it might be deep and prolonged. But history shows us that patient, disciplined investors are eventually rewarded. Part 3. The power of compounding and consistency. Albert Einstein allegedly called compound interest the eighth wonder of the world, and Robbins and Mallouk spend significant time in their book explaining why this concept is absolutely crucial to building wealth. But here's the thing, most people hear about compound interest and think they understand it, but they don't truly grasp its incredible power. They see it as a nice mathematical concept, rather than the wealth-building force it actually is. Let me paint you a picture that Robbins uses to illustrate this power. Imagine you are 25 years old and you start investing just $300 per month. That's $10 a day, less than what many people spend on coffee and lunch. If you invest this money consistently, in a diversified portfolio earning an average of 8% annually, by the time you are 65, you will have accumulated over $875,000. But here's where it gets really interesting. Let's say you wait until you are 35 to start investing. You invest the same $300 per month, earn the same 8% return, but you only have 30 years instead of 40. How much less do you think you would end up with? You might guess 25% less, since you invested for 25% less time. But you would be wrong. You would end up with about $408,000, that's roughly half as much. That lost decade cost you nearly $500,000. That's the power of compounding, and the cost of delay. The book drives home this crucial point: time is your greatest financial asset. Not intelligence, not luck, not even the amount of money you start with, time. The earlier you start, the less you need to invest to reach your goals, because compound interest does the heavy lifting for you. The authors also address a common excuse: I don't have enough money to start investing. They challenge this thinking by breaking down the numbers. Investing $100 per month might not seem like much, but over 30 years at 8% returns, it grows to nearly $150,000. Even $50 per month becomes about $75,000 over 30 years. The key insight here is that you don't need to be wealthy to start building wealth. You just need to start. The magic of compounding works for everyone, regardless of how much money you begin with. But, and this is crucial, compounding only works if you stay invested. Every time you panic and pull money out of the market, you interrupt the compounding process. Every time you stop investing, because times are tough, you are robbing your future self. Robbins and Mallouk make this point crystal clear. Real wealth is built by investing consistently and letting your money grow. It's not about timing the market or picking winning stocks. It's about time in the market and the discipline to keep investing, especially when it feels uncomfortable to do so. The compound interest curve starts slowly, but accelerates over time. In the early years, your gains come primarily from your contributions. But later, your gains come primarily from returns on your investments. Eventually, you reach a tipping point where your money is making more money than you are contributing. That's when you know compound interest is working its magic. Remember, start early, stay invested, and automate everything. Time is your greatest financial asset. Use it wisely. Part 4. 4 core principles of smart investing. Now that we understand the mindset and the power of compounding, let's dive into the practical strategies. Robbins and Mallouk distill decades of investment wisdom into 4 core principles that form the foundation of smart, unshakable investing. Principle 1. Don't lose money. This might sound obvious, but it's profound in its simplicity. Warren Buffett's first rule of investing is, don't lose money, and his second rule is don't forget rule number 1. The authors explain that avoiding big losses is more important than chasing big gains. Here's why. If you lose 50% of your money, you need a 100% return just to break even. Lose 20%, and you need a 25% return to get back to where you started. The math of losses is brutal. This principle is not about avoiding all risk. That's impossible and counterproductive. It's about avoiding unnecessary risks and catastrophic losses. It means not putting all your eggs in one basket, not chasing hot tips, and not investing money you cannot afford to lose. Principle 2. Asymmetric risk, reward. This is where smart investors separate themselves from gamblers. You want to find investments where the potential upside is much greater than the potential downside. In other words, you want to be in positions where you can make $3 for every $1 you might lose. The classic example is investing in a broad market index fund. Historically, These funds have provided positive returns over long periods, with the upside being essentially unlimited, while the downside is limited to 100% of your investment. Compare this to individual stocks, where you might lose everything if a company goes bankrupt, but the upside might not be significantly better than the overall market. Principle 3, diversify everything. This is perhaps the most important principle, and Robbins and Mallouk take it beyond just owning different stocks. True diversification means spreading your risk across different asset classes like stocks, bonds, real estate, commodities, different geographic markets, domestic and international, different company sizes, like large cap, mid cap, small cap, different investment styles, growth and value, different time periods, through dollar cost averaging. The book emphasizes that diversification is the only free lunch in investing. By spreading your investments across different areas, you can potentially reduce risk, without necessarily reducing returns. Here's a powerful example from the book. During the 2008 financial crisis, US stocks dropped about 37%. But if you had been diversified across multiple asset classes, your losses would have been much smaller. Some asset classes, like certain bonds and commodities, actually had positive returns during that period. Principle 4, tax efficiency. This principle is often overlooked, but it's crucial for long-term wealth building. The government is your silent partner in every investment, and they want their share of your profits. But there are legal ways to minimize this partnership. The authors strongly advocate for using tax-advantaged accounts like 401k, IRAs, and Roth IRAs. These accounts allow your money to grow tax-deferred, or even tax-free, dramatically increasing your long-term returns. Here's an eye-opening example. Let's say you invest $5,000 per year for 30 years in a taxable account, earning 8% annually. Assuming you are in the 25% tax bracket, your after-tax return is about 6%. You would end up with roughly $395,000. But if you put that same $5,000 in a tax-deferred account like a 401k, earning the full 8% return, you would end up with about $566,000. That's $171,000 more, just from being tax efficient. The investment vehicle of choice, index funds. Throughout the book, Robbins and Mallouk consistently advocate for low-cost index funds and ETFs as the best investment vehicle for most people. These funds give you instant diversification, low fees, and historically solid returns. They cite extensive research showing that the vast majority of actively managed funds fail to beat their benchmark indexes over the long term. Even worse, they charge much higher fees for this underperformance. Here's a startling statistic from the book. Over a 15-year period, less than 8% of actively managed funds beat their benchmark index. Think about that. More than 90% of professional money managers, with all their research, analysis, and expertise, cannot beat a simple index fund. The reason is simple: markets are efficient, and it's incredibly difficult to consistently pick winners. But it's easy to own a piece of the entire market through index funds, capturing the average return of all companies. Evidence-based investing, not speculation. The authors make a clear distinction between investing and speculating. Investing is based on evidence, research, and long-term thinking. Speculating is based on hunches, hot tips, and short-term thinking. Unshakable investors don't try to predict the future, they prepare for it. They don't chase the latest investment fad, they stick to time-tested principles. They don't let emotions drive their decisions. They let evidence guide their strategy. The key lesson here is that wealth is built with discipline and protection, not gambling. The goal is not to hit home runs, it's to consistently get on base and let compounding do the rest. These 4 principles might seem simple, but they are incredibly powerful when applied consistently over time. They are the difference between building lasting wealth and constantly starting over. They are what separate unshakable investors from everyone else. Part 5. The biggest threats to your wealth. Now let's talk about something that makes Robbins and Mallouk genuinely angry: the hidden forces that are systematically draining wealth from ordinary investors. These are not dramatic market crashes or economic disasters. These are quiet, persistent threats that most people don't even realize exist. Threat 1. High fees and hidden charges. This is perhaps the most insidious wealth destroyer, because it's hidden in plain sight. Most investors have no idea how much they are actually paying in fees, and the financial industry likes it that way. Here's a wake-up call from the book. A 2% annual fee might not sound like much, but over 30 years, it can cost you roughly 50% of your total returns. Let me repeat that: half of your potential wealth can be eaten up by fees. Let's put real numbers to this. Imagine you invest $300 per month for 30 years. In a low-cost index fund, charging 0.05% annually, you would end up with about $610,000. But in a high-fee mutual fund charging 2% annually, you would end up with only about $405,000. That's a difference of over $200,000 money that went into your fund manager's pocket instead of your retirement account. The book reveals that the average mutual fund charges about 1.5% per year, plus additional hidden costs that can push the total to over 3% annually. These fees are charged regardless of performance. You pay them whether your fund goes up or down. Threat 2. Active fund managers who underperform. This ties directly to the fee problem. Not only are you paying high fees for active management, but you are getting worse results than if you had simply bought an index fund. Robbins and Mallouk share research showing that, over 15-year periods, less than 8% of actively managed funds beat their benchmark index. This means more than 90% of professional money managers, people who are supposed to be experts at picking investments, cannot beat a simple computer program that just buys everything in the index. Even more frustrating, the few funds that do beat the market in one period rarely repeat their success in the next period. Past performance truly is no guarantee of future results. The book asks a simple question: if you knew that 9 out of 10 professional money managers would underperform while charging you higher fees, would you still hire them? Of course not. Yet that's exactly what most investors do. Threat 3. Overtrading and emotional investing. Here's another way people destroy their own wealth: trading too frequently. The book cites research showing that the more frequently people trade, the worse their returns become. Why? Because most people buy and sell at exactly the wrong times. They get excited and buy when markets are high and everyone is optimistic. They get scared and sell when markets are low and everyone is pessimistic. This is the opposite of successful investing. Robbins shares a study showing that investors who checked their accounts frequently and traded regularly earned significantly lower returns than those who adopted a buy and hold strategy. The constant monitoring and tweaking actually hurt their performance. The lesson here is clear: the best investment strategy is often the most boring one. Buy quality investments, hold them for the long term, and resist the urge to constantly tinker with your portfolio. Threat 4. Lack of diversification. Many people think they are diversified when they are actually not. Owning 10 different mutual funds is not diversification if they all invest in the same types of companies. Owning stocks in 5 different tech companies is not diversification, it's concentration in one sector. The book emphasizes that true diversification means spreading risk across different asset classes, geographic regions, company sizes, and investment styles. It means not putting all your eggs in one basket, even if that basket has historically performed well. Remember, every dollar you save in fees is a dollar that can compound and grow for decades. Avoiding these wealth-destroying threats isn't just about saving money, it's about potentially adding hundreds of thousands of dollars to your lifetime investment returns. The Unshakeable investor recognizes these threats and systematically avoids them. They understand that sometimes the best investment decision is the one you don't make. Part 6. Choosing the right financial advisor. Here's a reality check that might surprise you: most financial advisors are not actually required to act in your best interest. In fact, many of them are legally allowed to put their own financial interests ahead of yours. Robbins and Mallouk spend considerable time in their book helping readers navigate this confusing landscape. The difference between salespeople and fiduciaries. The financial industry is full of people with impressive titles: financial advisor, investment consultant, wealth manager. But titles don't tell you the most important thing: whether they are legally required. To act in your best interest, there are essentially 2 types of financial professionals: those who are fiduciaries and those who are not. A fiduciary is legally bound to act in your best interest, even if it means they make less money. A non-fiduciary only needs to ensure that their recommendations are suitable for you, even if there are better options available. Think of it this way: a fiduciary is like a doctor, who must recommend the best treatment for your condition. A non-fiduciary is like a salesperson, who only needs to recommend a treatment that will not harm you, even if it's not the best option. The commission problem: many financial advisors are paid through commissions on the products they sell. This creates an obvious conflict of interest. If an advisor makes a 5% commission selling you one investment but only 1% commission selling you another, which one do you think they are more likely to recommend? The book reveals that commission-based advisors often push high-fee mutual funds, insurance products, and other investments that generate large commissions, but provide inferior returns for investors. They are not necessarily bad people, but they are operating in a system that rewards them for selling, not for your investment success. What to look for in a financial advisor. If you decide to work with a financial advisor, Robbins and Mallouk provide clear criteria for choosing the right one. First, they must be a fiduciary. This is non-negotiable. Ask directly: are you legally required to act as a fiduciary and put my interests first? If they cannot give you a clear yes, walk away. Second, they should be fee-based, not commission-based. Fee-based advisors charge you directly for their services, either through an annual fee or an hourly rate. This aligns their interests with yours. They succeed when you succeed, not when they sell you something. Third, they must be transparent about all costs. A good advisor will clearly explain all fees, including their own compensation and any costs associated with the investments they recommend. If an advisor cannot or will not explain their fees in simple terms, that's a red flag. Fourth, they should have relevant credentials. Look for designations like CEP, Certified Financial Planner, CFA, Chartered Financial Analyst, or similar credentials that require extensive education and adherence to ethical standards. Resources for finding good advisors. The book recommends several resources for finding qualified fiduciary advisors. NAPFA, National Association of Personal Financial Advisors. All members are fee-only fiduciaries. XY, Planning Network, specializes in advisors who work with younger investors and those with smaller portfolios. The book emphasizes that successful investing doesn't require complex strategies or constant monitoring. A simple portfolio of low-cost index funds, automatically rebalanced once or twice per year, will outperform most actively managed strategies over the long term. Red flags to avoid. Robbins and Mallouk warn about several red flags when dealing with financial professionals. 1. Anyone who promises guaranteed returns above market rates. 2. Advisors who push complex products you don't understand. 2. Anyone who suggests you need to act quickly on an opportunity. 3. Advisors who cannot clearly explain how they are compensated. 4. Anyone who discourages you from getting a second opinion. The bottom line: the right financial advisor can be a valuable ally in your journey toward financial freedom. They can provide guidance, accountability, and expertise that helps you stay on track toward your goals. But the wrong advisor can cost you hundreds of thousands of dollars in unnecessary fees and poor investment choices. The key is knowing the difference. A good advisor is transparent about their fees, legally bound to act in your best interest, and focused on long-term wealth building rather than short-term sales. Remember, you are not just hiring someone to pick investments for you, you are hiring someone to help you make smart financial decisions for decades to come. Take the time to find the right person, or be confident enough to go it alone with a simple, low-cost approach. Part 7, Asset Allocation and Rebalancing. Let's talk about what might be the most important investment concept you have never heard of: asset allocation. According to Robbins and Mallouk, this single factor determines roughly 90% of your investment returns over time. Not stock picking, not market timing, not finding the next hot fund. Asset allocation. What is asset allocation? Asset allocation simply means how you divide your investment portfolio among different types of investments: stocks, bonds, real estate, commodities, and cash. It's your investment recipe, and like any good recipe, the proportions matter enormously. Think of asset allocation like building a balanced meal. You want some protein, some vegetables, some carbohydrates, and some healthy fats. Each component serves a different purpose, and the combination is more nutritious than any single ingredient alone. In investing, different asset classes serve different purposes. Stocks provide growth potential but with higher volatility. Bonds provide stability and income, but with lower growth potential. Real estate provides inflation protection and diversification. Commodities provide hedges against inflation and economic uncertainty. Cash provides liquidity and safety but with minimal growth. The all-weather strategy. Robbins introduces what he calls the all-weather portfolio, inspired by legendary investor Ray Dalio. This approach is designed to perform reasonably well in all economic environments, whether we're experiencing growth or recession, inflation or deflation. The basic all-weather allocation looks something like this: 30% stocks, for growth, 40% long-term bonds, for stability, 15% intermediate-term bonds, for income, 5% commodities, for inflation protection, 7.5% REITs, for real estate exposure. This is not a get-rich-quick portfolio, it's a get-rich-for-sure portfolio. It's designed to provide steady, consistent returns, while minimizing the risk of catastrophic losses. Why asset allocation matters more than stock picking. Here's a fact that might shock you. A landmark study found that asset allocation determines about 91.5% of portfolio performance over time. Security selection determines only about 4.6% of returns. Market timing determines even less. This means you are better off spending your time figuring out the right mix of investments, rather than trying to pick winning stocks or time the market. The allocation decision is vastly more important than the selection decision. The rebalancing discipline. Asset allocation is not a set it and forget it strategy. Over time, your portfolio will drift away from your target allocation as different investments perform differently. If stocks have a great year, they might grow from 50% of your portfolio to 60%. If bonds have a tough year, they might shrink from 30% to 25%. This is where rebalancing comes in. Rebalancing means periodically adjusting your portfolio back to your target allocation. It sounds simple, but it's psychologically challenging, because it requires you to sell investments that have done well and buy investments that have done poorly. But here's the magic. Rebalancing forces you to buy low and sell high automatically. When you rebalance, you are taking profits from your winners and investing in your losers when they are on sale. Over time, this discipline can significantly boost your returns. How often should you rebalance? The book recommends rebalancing every 6 to 12 months, or whenever any asset class drifts more than 5% from its target allocation. You don't need to rebalance constantly. That would generate unnecessary transaction costs and taxes. But you also cannot ignore it completely. Age-based allocation. One common question is, how should your asset allocation change as you get older? The traditional rule of thumb is to subtract your age from 100 to determine your stock allocation. So a 30-year-old would have 70% in stocks, while a 60-year-old would have 40% in stocks. But Robbins and Mallouk suggest this rule might be outdated in today's world of longer lifespans and low interest rates. They argue that even retirees need significant growth investments to maintain their purchasing power over 20 to 30-year retirements. The psychology of asset allocation. Here's something most people don't realize. The best asset allocation is the one you can stick with during market turbulence. It doesn't matter if an allocation is theoretically optimal. If you are going to panic and abandon it during the next bear market, this is why the book emphasizes starting with an allocation that feels comfortable, even if it's not perfect. You can always adjust it over time as you become more experienced and comfortable with volatility. Dollar cost averaging. Time diversification. The authors also discuss time diversification through dollar cost averaging, investing the same amount regularly, regardless of market conditions. This spreads your purchase dates over time, which can reduce the impact of market volatility. When markets are high, your regular investment buys fewer shares. When markets are low, the same investment buys more shares. Over time, this can result in a lower average cost per share than if you had invested a lump sum at the wrong time. The allocation advantage. Proper asset allocation provides several key benefits. First, it reduces portfolio volatility. Different asset classes often move in different directions, so when one is down, another might be up. This smooths out your overall returns. Second, it helps you sleep better at night. When you are properly diversified, no single investment can destroy your portfolio. Even if one asset class has a terrible year, the others can help cushion the blow. Third, it takes emotion out of investing. When you have a systematic approach to allocation and rebalancing, you are less likely to make impulsive decisions based on market news or emotions. Remember, asset allocation is not about finding the perfect portfolio, it's about finding a good portfolio that you can stick with through all market conditions. The best allocation is the one that keeps you invested and disciplined over the long term. Part 8. The wealthy invest differently. One of the most fascinating parts of Unshakeable comes from Robbins' unprecedented access to some of the world's most successful investors. He interviewed over 50 financial legends, people who have built multi-billion-dollar fortunes through investing. What he discovered might surprise you. It's not what you think. You might expect these financial titans to have complex, sophisticated strategies involving exotic investments, algorithmic trading, or insider knowledge. But the reality is quite different. The world's wealthiest investors share remarkably similar approaches, and they are surprisingly simple. Common trait 1. Long-term thinking. Every single successful investor Robbins interviewed thinks in decades, not days. They are not worried about what the market will do next week or next month. They are focused on where their investments will be in 10, 20, or 30 years. Warren Buffett, arguably the most successful investor of all time, famously said his favorite holding period is forever. He's not interested in quick profits, he's interested in owning pieces of great businesses for the long haul. This long-term perspective allows wealthy investors to ignore short-term market noise and focus on fundamental value. While ordinary investors are panicking about daily market movements, the wealthy are thinking about long-term trends and opportunities. Common trait 2. Obsession with risk management. This might be the most important insight. Wealthy investors are not big risk takers, they are actually extremely conservative when it comes to protecting their wealth. They understand that avoiding big losses is more important than chasing big gains. Ray Dalio, founder of Bridgewater Associates, told Robbins that he's more afraid of being wrong than excited about being right. This fear of loss drives him to constantly question his assumptions and hedge his bets. The wealthy don't swing for the fences, they focus on not striking out. They'd rather make consistent, steady returns than risk everything for a home run that might never come. Common trait 3. Patience. Perhaps the most undervalued skill in investing is patience. The wealthy investors Robbins interviewed all demonstrated extraordinary patience. They are willing to wait years for the right opportunity, and once they find it, they are willing to wait years more for it to pay off. This patience allows them to buy when others are selling in panic, and hold when others are selling in impatience. They understand that wealth building is a marathon, not a sprint. Common trait 4. Simple strategies. Here's what might shock you most. The world's wealthiest investors use surprisingly simple strategies. They don't have secret formulas or complex algorithms. They focus on basic principles applied consistently over long periods. Carl Icahn focuses on buying undervalued companies. Warren Buffett focuses on owning great businesses at fair prices. Ray Dalio focuses on balancing risk across different economic environments. These are not complex strategies, they are simple principles executed with discipline. They focus on certainty, not excitement. The wealthy investors Robbins interviewed are not looking for exciting investments, they are looking for certain ones. They want investments they can understand, in businesses they can predict, with outcomes they can reasonably expect. This is the opposite of how most people invest. Most people are attracted to exciting stories, hot tips, and get-rich-quick schemes. The wealthy are attracted to boring, predictable, profitable businesses. Remember, the goal is not to invest like you are wealthy, it's to invest in a way that will actually make you wealthy. The principles that built the fortunes of the world's richest investors can work for anyone willing to apply them consistently over time. Part 9. Real financial freedom. Redefining wealth. as we near the end of our journey through Unshakeable, Robbins and Mallouk want us to think bigger than just accumulating money. They challenge us to redefine what wealth really means, and to understand the true purpose of financial freedom. Beyond the number, most people think financial freedom is about reaching a specific number, $1 million, 10 million, or whatever figure seems impressive. But the authors argue that real financial freedom is not just about a number, it's about peace of mind. It's about having options. It's about the ability to live life on your own terms. Think about it. What good is having $1 million if you are constantly worried about losing it? What's the point of wealth if you don't have the time or health to enjoy it? True financial freedom means sleeping soundly at night, knowing that you and your loved ones are secure. The 5 levels of financial freedom. Robbins introduces a framework that helps you think about financial freedom as a journey rather than a destination. He outlines 5 distinct levels, each representing a different degree of financial security. Level 1, financial security. This is your foundation. You have enough saved to cover your basic needs for a period of time if your income stops. This typically means having 6 to 12 months of expenses saved in an emergency fund, plus enough invested to generate income for your most basic necessities: housing, food, utilities, and transportation. Most people never reach even this basic level of security, which is why they live in constant financial stress. But achieving level 1 security can transform your life, giving you confidence and options you have never had before. Level 2, financial vitality. At this level, your investments generate enough income to cover not just your basic needs, but also some of your lifestyle wants. This might include dining out, entertainment, hobbies, and travel. You are not living like a monk, but you are not living extravagantly either. Level 3, financial independence. This is where most people want to be. At this level, your investment income covers your entire current lifestyle without having to work. You could stop working tomorrow and maintain your standard of living indefinitely. This is true financial independence. Work becomes a choice, not a necessity. Level 4, financial freedom. Here's where life gets really interesting. At this level, you have more income from investments than you need for your current lifestyle. You can upgrade your lifestyle significantly: better home, luxury travel, premium experiences, while still maintaining your financial independence. Level 5, absolute financial freedom. This is the ultimate level, where money is no longer a consideration in any decision you make. You can buy anything you want, go anywhere you want, and support any cause you believe in, without impacting your financial security. Very few people reach this level, but it's worth understanding what it represents. Your freedom number. The key insight here is that you need to define your own freedom number. What level of financial freedom do you actually need to be happy? For some people, level 1 security is enough to transform their lives. Others will not be satisfied until they reach level 4 or 5. There's no right or wrong answer, but there is a wrong approach: pursuing financial freedom without defining what it means to you. If you don't know your destination, you will never know when you are arrived. Remember, building real financial freedom takes time. It's not about getting rich quick, it's about getting rich for sure. Most people who achieve significant financial freedom do so over decades, not months or years. Financial freedom is not just about the destination, it's about becoming the kind of person who can build and maintain wealth responsibly. It's about developing the discipline, patience, and wisdom that create lasting prosperity. Conclusion: your unshakable path forward. We have covered a lot of ground in our journey through Unshakeable, and now it's time to bring it all together. Tony Robbins and Peter Mallouk have given us a comprehensive roadbook for building lasting wealth, but ultimately, the most important chapter is the one you write with your actions. Let's quickly recap the core insights that can transform your financial future. First and most importantly, markets move, but you don't have to. Volatility is normal, corrections are predictable, and crashes always end. The investors who panic during downturns are transferring their wealth to those who remain calm and disciplined. Your ability to stay unshakable during market turbulence is not just a nice skill to have, it's the difference between building wealth and losing it. Second, build wealth with discipline, time, and low-cost strategies. compound interest is the eighth wonder of the world, but it only works if you stay invested consistently, over long periods. Start early, invest regularly, and let time do the heavy lifting. The magic is not in picking perfect investments, it's in staying invested, while everyone else is getting scared and selling. Third, avoid the wealth destroyers. High fees, emotional decisions, lack of diversification, and poor advice can cost you hundreds of thousands of dollars over a lifetime. Every dollar you save in fees is a dollar that can compound for decades. Every emotional decision you avoid is a potential disaster prevented. Fourth, focus on what you can control. You cannot control market movements, but you can control your behavior. You cannot predict the future, but you can prepare for it. You cannot time the market, but you can spend time in the market. If there's one practical takeaway that can immediately improve your financial future, it's this: automate everything you can. Set up automatic transfers to your investment accounts. Set up automatic rebalancing of your portfolio. Make investing as routine as paying your phone bill. Remember Robbins' central message: becoming unshakable is not about suppressing your emotions, it's about understanding them and not letting them drive your financial decisions. Fear and greed are natural human responses, but they are terrible investment advisors. Remember that every wealthy investor has lived through multiple market crashes and corrections. They didn't get wealthy by avoiding volatility, they got wealthy by staying invested through volatility. As Robbins says in the book, you cannot control the economy, but you can control your plan. You cannot control the markets, but you can control your behavior. You cannot control what happens to you, but you can control how you respond to what happens to you. That's how you become unshakable. Thank you for joining me for this exploration of Unshakeable, your financial freedom playbook. Remember, your financial future is not determined by market returns or economic conditions. It's determined by the decisions you make and the discipline you maintain. You have everything you need to become financially unshakable. The only question is, will you choose to use it? The path is clear. The principles are proven. The only thing left is action. Your unshakable financial future starts now. If you found this valuable, give it a like, share it with someone who needs to hear it, and subscribe for more summaries.